All right, let's get into some exercises related to intangible assets and amortizing them. Let's kick things off in the handout with BE 12.1. It says Taylor Swift Corporation purchases a patent from Salmon Company on January 1st, year one, for $54,000. The patent has a remaining legal life of 16 years. But Taylor Swift feels the patent will be useful for 10 years. Here's the difference between useful life and legal life. Prepare Taylor Swift's journal entries to record the purchase of the patent and the year one amortization. Okay, well, let's take care of the purchase first. This is BE 12.1, the purchase on January 1st. We bought a patent. We have an intangible asset that would appear on the balance sheet as patent for $54,000. And I'm not sure if it says this explicitly, but we will assume we paid cash of $54,000. Let's stop there. Think about the implications on the financial statements. Do you guys see any effect on the income statement here? I don't. I see that this company essentially traded one asset for another. There's no implication on the balance sheet. They gave up cash. What did they get? An intangible asset in return. How about the amortization expense at the end of the year? Well, this says that the useful life is 10 years. With these intangible assets, we're going to assume that salvage value is 0. So 1 year's worth of amortization expense would be the $54,000 cost divided by 10 years, which is $5,400. So at the end of the year, we'll record amortization expense for $5,400. And we would credit the patent or accumulated amortization. We'll just go with patent for $5,400. Can you see what the book value would be? We've got a cost of $54,000. We just decreased it by $5,400. So our carrying value on the balance sheet after year one would be $48,600. All right, let's look at BE 12.2 in the handout. It says use the information from BE 12.1. Assume that on January 1st, year one, the carrying amount of the patent on Taylor Swift's books is $43,200. In January, Taylor Swift spends $24,000 successfully defending a patent lawsuit. Taylor Swift feels that the patent will be useful until the end of year 8. Prepare the journal entries to record the $24,000 expenditure and amortization for year 1. Let's take care of this successful defense of the patent. We know that Taylor Swift dispersed $24,000 in cash. Because this suit was successful, instead of expensing it immediately, we will capitalize this cost, adding $24,000 to the patent balance. Now, let's think about amortization. Where do things stand right now with our depreciable or amortizable base? We had an original cost of $43,200. And then we had the addition for the cost associated with the successful defense of the patent, and that was $24,000. So we have $67,000 of expected future benefit in the form of an intangible asset. We need to amortize this $67,000 to expense over the useful life of this patent, which is 8 years. So $67,000 divided by 8 years is $8,400 in amortization expense each year. So our journal entry would be amortization expense, $8,400, and patents or accumulated amortization, we'll go with patents now, and a credit to $8,400. Okie dokie, let's do another exercise. This one is E12-4 in the handout. Altori purchased a patent from Vanny Company for $1 million on January 1st, year 1. The patent is being amortized over the remaining legal life of 10 years, so it expires January 1st, year 11. During year 3, Altori determined that the economic benefits the patent has would not last longer than 6 years from the date of acquisition. Originally they said 10 years, right? So we have a change in useful life estimate. What amount would be reported in the balance sheet for the patent net accumulated amortization at December 31st, year 3? All right, let's get into this. So the cost of this patent was $1 million. And originally, they thought the useful life would be 10 years, right? So the annual amortization of this cost to expense would be equal to the $1 million in cost divided by 10 years, or $100,000. So year 1 amortization, 100. Year 2 would have been $100,000. Now remember, in year 3, here's where they determined that the patent's not going to last as long as they thought it would. It's going to last 6 years from the date of acquisition. 2 years have already passed. This means at this point in time, we're estimating that only 4 years of useful life remain on this asset. So we need to take this into consideration when we are calculating and recording the amortization expense for year 3. So the year 3 amortization expense would look like this. The book value at the beginning of year 3 would be what? Well, we paid $1 million for it. We had 2 years of amortization when we were working under the assumption that it was a 10-year useful life. So as it stands right now, our net book value is $800,000. And also at this point in time, we're saying that this asset is only going to last 4 more years. So our useful life as of year 3 is 4 years. So this means that for the next 4 years, we will have $200,000 of amortization expense each year. So I'm going to add that here. We've got year 1 of 100,000, year 2 of 100,000, and here's year 3 amortization, 200,000. So at the end of year 3, net book value on this will be cost of $1 million minus our total amortization over these 3 years. That's $400,000. And our ending book value for this intangible asset is patent $600,000. Let's look at the second part of E12.4. In this part, we're going to assume that Altori purchased the license for distribution of a popular consumer product on January 1st, year 3, for $150,000. It's expected that this product will generate cash flows for an indefinite period of time. The license has an initial term of 5 years, but by paying a nominal fee, Altori can renew the license indefinitely. What amount should be amortized for this $150,000 consumer product? Well, because this is easily renewed and it's considered to have an indefinite life, we're not going to amortize it. So the answer to this is no amortization is going to be recorded. Instead, what do we do with intangibles that have indefinite useful lives? We examine them for impairment. Let's look at another exercise in the handout related to impairment. This one is B12.10. Sinise Industries acquired 2 copyrights during 2020. One copyright related to a textbook that was developed internally at a cost of $9,900. The textbook is estimated to have a useful life of 3 years from September 1st, 2020, the date it was published. The second copyright, a history research textbook, was purchased from University Press December 1st, 2020 for $24,000. The textbook has an indefinite useful life. How should these 2 copyrights be reported in the balance sheet at the end of 2020? Copyright number 1. It said this was internally created at a cost of $9,900. Since it was internally created, this cost will not be capitalized and instead will be expensed immediately. No capitalization on the balance sheet, just an expense and decrease in net income on the income statement. How about copyright number 2? Well, this $24,000 was a copyright that was purchased from an external party for $24,000. So this should be capitalized as copyright, as an intangible asset. We would debit copyright for $24,000, credit cash for $24,000. And because it is has an indefinite life, we wouldn't have amortization annually, but instead we would test it for impairment.